Hello, everybody. We are going to get started here in just a second. If you're tuning in, thank you very much for joining. We're very excited today to be talking about hedge fund strategies. So we're just going to wait a couple more minutes and then we will get started. In the meantime, maybe I can play some music for you guys. We're going to start in just a minute or so. I see plenty of people tuning in. Glad to have everyone here. All right, folks, we will get started very shortly. Okay. Well, welcome to Money Talks. We are going to be talking about hedge fund strategies today. Why are we presenting this information? Well, it's something that we feel very strongly about at Cadence Translate. The majority of the work we do is in the financial services sector, more specifically the asset management sector. And as we've engaged with many different clients and interpreters and translators and transcribers, we realized there really was a lack of knowledge or a lack of structured learning available out there for how do some transactions come together. So this webinar is going to give you an insight into how hedge funds conduct their investment strategies with a specific lens into how you can be a better participant in any meetings, conversations, documents, etc., that may involve them. So if this is your first webinar with us here at Cadence on Zoom, a couple things to point out. So I'm going to be speaking for 30 to 40 minutes, and then we will open it up for Q&A. You can ask questions at any time. Just type them into the Q&A box. If they are something that is being asked about the slide at hand, I will answer it right away. If I don't answer it right away, don't worry. I've seen the question. It will just get answered at the end of the presentation. If there are any other questions, just feel free to email us afterwards. You'll get our contact info at the end. But why don't we get started? So I always like to start with a quote to anchor us. Peter Lynch is one of the world's most famous investors, and he says when it comes to investing, if you're good, you're right 6 times out of 10 in this industry. So we have to remember that as hedge funds do their work, they aren't necessarily getting everything right. It's just a matter of being right more often than you're being wrong. So what are you going to learn today? Well, you're going to learn what a hedge fund is. You're going to learn how hedge funds make money. You'll learn about variations on hedge fund strategy. And importantly, because this is, at the end of the day, a audience of language professionals and others, you'll learn tricky terminology used when describing hedge funds and their actions. So you'll notice if we ever bold a word and put a red background on it, like you see here, that's a jargon that we especially want you to be able to prepare for, to understand, etc. We'd be more than happy to answer specific definitions as to what these terms may mean. So why am I taking up an hour of your time on this lovely Thursday evening if you're in the US or Friday morning if you're in Asia? Well, I was on the buy side for 5 years before joining Cadence. And if you don't know what the buy side is, that's perfectly fine. We're actually going to cover that in the very beginning. I've been servicing hedge funds beginning all the way in 2006, so before the global financial crisis. And these days at Cadence, I'm working with hedge funds every single week. So let's get into it. Where do hedge funds fit in this world? And why did I just say buy side? Well, it's pretty simple. Buy side refers to people who take money and invest it in other things. The phrases that you might have heard around the buy side often refer to different participants in the buy side. So you can see on this list here, mutual funds, ETFs, private equity, hedge funds, venture capital. These make up the buy side. And you can see here how much money they are managing globally at any given time. I thought this was actually somewhat surprising. The perception of perhaps venture capital is that they are so big and ubiquitous, but actually they are only 1/6 the size of hedge funds based on their assets under management. And to be clear, a lot of the investment strategies we're going to talk about today can be used by some of these other participants in the buy side, but we're especially going to focus on hedge funds. So, open question to the audience. Do hedge funds own Starbucks? Right? What do hedge funds invest in? And why did I put NASDAQ:SBUX on here? Well, that is the ticker for Starbucks. And we've noticed colloquially in conversation, in casual emails, a lot of participants in the hedge fund world don't refer to companies by their name, they refer to it by their ticker. So a couple hours ago, it was very famous, a day that will go down in history, AAPL just hit $1 trillion. What I mean by that is Apple, the company, hit $1 trillion, and I'm using the ticker to refer to it. So the answer is absolutely, hedge funds own Starbucks, and we'll explain that in a second. One thing I want to point out, well, the buy side manages all of this money, but whose money is it anyway? What you can see here are the different sources of capital that decide, you know what, I'm sitting on all this money, I want someone else to manage it. Maybe it's because I want to minimize the risk that this capital doesn't go away, or maybe it's the opposite. Maybe they want to take more risk and they want to put that money with a manager who has access to interesting investments or has been proven to be very good at developing investment theses. So you can see here, I'm not going to go through all 5 of these, but these are the types of institutions that are investing in hedge funds. So let's take that Starbucks example and let's look at a few different ways that hedge funds can actually invest in Starbucks. We're going to talk about 4 trading strategies today: long-short investing, algorithmic or what's called quant investing, arbitrage, and event-driven investing. Long-short is the easiest. Someone says, I like Starbucks, so I'm going to buy their stock. Quite simple to understand. Let's unpack that a little bit. In this world, you can either be long a stock or short a stock. Long means you make money when the stock goes up. Short means you make money when the stock goes down. Maybe you've heard these terms before, maybe you already knew that, but now what we're going to do is go through the mechanics of how that actually works. But you can think about these as, do I believe this stock is going to do better or worse than the overall market? What you're seeing here are 2 screenshots from a great website called The Motley Fool. And you can see, how do you think SBUX, I told you everyone uses tickers, will perform against the market? And you see a lot of green in there. Generally speaking, people are positive on Starbucks. By contrast, if you look at TSLA, Tesla, there's a significant amount of people that think this stock will underperform. So again, long and short, you can also think of as, is this company going to do better or worse than the market? It can also be used as a hedging strategy. People might say, I don't know if oil prices, what they're going to do. I think they're going to go down, but just in case, I'm long BP and XOM. Again, these are 2 stock tickers of BP, the oil company, and Exxon, the oil company. So they're saying, I think oil prices are going to go down, but in the event I'm wrong, I want to make money. Therefore, I'm going to go long a stock that benefits if oil prices go up. It can also be used, this concept of long short, to gain more exposure to a trend. For example, here in the United States, a lot of people have been talking about the future of going to the movies. Someone might say, you know what, no one's going to the movies. I'm going to buy Netflix and sell AMC. So what they mean here is they're going to go even deeper into the exposure. They're going to say, I am so confident in my thesis, I'm going to go long one stock and short another. So what does it mean to complete a long trade? Well, now we're really going to start getting into the different vocabulary that you can expect to see. Generally, an analyst will take their investment idea to someone to get it approved. When it's approved, you don't just go onto a website and say, buy 100 shares of this, because you're often dealing with millions of shares. So you actually hand off that trade to an in-house or third-party trader to actually make the transaction. And here's an important phrase you might come across. If it's a third-party trader, that's known as prime brokerage. The trader is then going to execute that trade. Maybe they do it all at once. Maybe they do it one at a time. Literally what they are going to do is, if you're long, meaning you're buying a stock, you're going to find a seller among the so-called float. The float are the shares that are made available to the public to buy and sell. And then finally, this trade, and any trade in general, will have what's known as a cost basis. So you may say, I'm long Starbucks, and the market price for Starbucks today might be $20, but by the time the trade happens, maybe the price moved and the average cost of a stock in that trade was $20.15. So that $20.15 would be your cost basis. So if that's a long, let's look at what a short is. It's a little more complicated, as you'll see. Even just the density of this should reveal it to how complicated it is. Again, it starts with the same idea. I have an investment hypothesis. I get it approved. I hand it off to someone. I now have to have the trader find two people. Someone who is willing to buy the shares, but you might say, well, what shares? I don't even own shares yet. I need to find someone who's willing to temporarily give up possession of their shares, what we can think of as a lender. So in this case, the trader takes the shares from the lender, immediately sells them to the buyer. So now they're sitting on cash. Now, sometime in the future, the lender is going to demand that these shares come back to them, right? I loaned you my shares. It's time for me to get them back, which means the hedge fund then has to purchase those shares from the open market. So they're going to make money if the open market price is less than what they paid for it. And in the industry, this is called covering your position. There's a lot more we can talk about this. There's a great phrase called short squeeze related to this, but we're going to move on. Recognize that this is one of the more complicated concepts here. Two words you're also going to see come up quite often in long-short analysis is, were people doing this based on fundamental analysis or technical analysis? Fundamental is you do something that is specific to the company. In this case here, oh, I visited 50 stores, and many, many times all of these stores were growing quickly. That is very specific to this company. Technical analysis is number crunching, quite literally. All it does is look at the numbers that a company is doing, and it somewhat ignores everything else in the company. And in fact, this is a good segue to the second trading strategy we're going to talk about. So technical analysis is, I need to think about running some analysis, and that will let me decide if I want to go long, short. Let's talk about algorithmic trading, because in that, as you can see here, this is, I'm going to buy Starbucks if Watson or just some algorithm tells me I should. So what this means is you are taking data to make short-term investment decisions. And in this world, the only thing the humans do is they provide some structure to the algorithms, and they will set trading limits so that the algorithms can't bankrupt a company. And a phrase that you might often hear associated with this is HFT, high-frequency trading. It's really important to understand that this is so different than long-short investing, In algorithmic or quant trading, you might hold a position in seconds, meaning I'm going to buy 100 shares of Starbucks right now, and I'm going to sell it in 20 seconds. That is only possible, if you think about it, by two things. Number one, technology, which allows you to execute trades quickly after you've decided to execute them, and trading costs, which are going down over time. So here's a real life example of a quant algorithm. You might say, you know what, if a stock has gone up recently, buy more of it. If a stock has gone down recently, sell it. That's something called momentum trading. You can see in red here, and that's actually used as somewhat of a negative word. If you were to say, oh, this hedge fund, they're just momentum traders, that's actually a bit of an insult to that hedge fund. And what does it look like? It's literally computer code. What you're seeing here is publicly available computer code from one of my favorite companies out there, which I'm going to talk about a little bit later in this webinar. One thing that's important to point out is the labor market for the humans that set up this analysis is crazy. So first of all, they're called quants, which is an interesting word. At the end of the day, they're really good at data manipulation and coding. In some sense, it doesn't really matter what markets they're looking at. If you were to ask a quant person to describe the dynamics in the oil market, they might have no clue, even if they've made millions of dollars trading oil shares or oil futures. At the end of the day, these are folks who are really good at math, really good at coding. This is also a trading strategy fraught with danger. In 2010, I was in New York working at a private equity firm, and everyone stopped because the Dow had crashed almost 1,000 points in minutes, which usually is associated with either a terrorist event or just something awful. But in this case, it was all started because one of the quants out there had their algorithm go crazy and was selling and buying in a irrational way, which therefore triggered more irrationality. Happy to answer more questions on this, but in the interest of time, we're going to keep going. Let's talk about arbitrage. This is a fascinating concept that extends to more than just hedge fund strategies. And as you can see on the slide here, it may not have anything to do with the underlying stock. So as we think about Starbucks, if someone were to make money doing arbitrage and it had something to do with Starbucks, they might say, well, I can sell coffee beans for $10 in Guatemala. I can pay $2 to store them for 6 months. I can sell them for $15 today to buyers in 6 months. I'm going to execute all three of those agreements today. I'm going to pay 10 bucks, I'm going to pay $2, and I'm going to sell something for $15. So I've locked in $3 of profit. So you can see what arbitrage is you're taking advantage of what is often a temporary pricing anomaly. You are quite literally buying something in one market and simultaneously selling it in another. And when we were putting this webinar together, we were thinking, okay, how should we come up with an example of this? There's M&A arbitrage, there's commodities arbitrage. I decided to make it a little more personal. And so let me tell you a story of how yours truly encountered and temporarily benefited from arbitrage. So when I was 14 years old, I obsessively played this video game called Ultima Online. It was all I could think about all day, and it was one of these persistent games, meaning the actions you do can never be reset. And if you die in the game, you can't come back, etc. And I realized that there were these magician robes, which you can see on screen here. And in one town, they sold for 80 gold, and in another town, they sold for 100 gold. And I could get myself between those towns instantaneously in this video game by spending the equivalent of 5 gold. And in general, I could hold about 20 robes at a time, and buying them, transporting myself to the other town, selling them, and coming back and depositing the gold took me about 15 minutes. So you can see here, what was my profit? Well, it was what I sold the product for, minus what I paid for the product, minus any transaction fees. And that is arbitrage. Instantaneously locking in a profit with the recognition that you may not be able to do this again because it's a short-term anomaly. Now, just to bring it back to the real world, as fun as it is to talk about Ultima Online, it's actually quite hard to find arbitrage in the equities market. We were talking about buying Starbucks, buying Tesla. Those are equities. So what often happens if you want to conduct arbitrage is you have to resort to buying and selling derivatives, which is a huge, huge world. I took an entire class when I was an undergrad on derivatives. It's very complicated. We would love to feature it as another Money Talks webinar. So we're not going to dive into it today, but recognize that in general, this strategy is quite popular, but it's hard to do it in equities unless you do derivatives. Alternatively, what you could do is the example that I mentioned a couple minutes ago. You have commodities. So you might buy oil to be delivered in one part of the world. You might contract with someone to ship and store that oil to somewhere else in the world. And you might line up a seller and you will execute all three things at once. So commodities, it just is more intuitive to do this. And last thing I'll mention, the existence of such arbitrage opportunities is incredibly short term. Hedge funds that specialize in arbitrage opportunities, they're not doing the same arbitrage strategy day in, day out, and just pushing a button and getting $1 million of profit. They're always having to look out for new strategies, which is why you'll often see them looking at the most obscure markets in the world, which might lead them to using research that might include translation, interpretation, or transcription. So let me close this particular element with a great story. The whole concept of arbitrage is that information is unevenly distributed. And if you can get access to one of those short-term mispricings, you can make a lot of money. So if information is unevenly distributed, it follows that there should be people out there, entrepreneurs out there, who want to accelerate access to information. So one of my favorite books is Flash Boys by Michael Lewis. And the first chapter tells this story of this entrepreneur who said, it takes about 17 milliseconds for an order placed in Chicago to reach trading floors, or more realistically, trading exchanges in New York City. Or conversely, if some data comes out in New York City, it takes some amount of time to come to Chicago. So this entrepreneur said, I am going to build a straight cable going from Chicago to New York. It is going to turn as few times as possible. It's going to be made of the world's fastest material to conduct energy and relay information. And I'm going to sell this to hedge funds, because hedge funds will pay anything for that extra boost of either productivity or access to information. So this guy raised money and spent $300 million and was able to make hundreds of millions of profits selling access to this cable. So the line you see here is literally where that cable goes in between. You can see it's not a straight line, but it was the absolute best engineering feat that could be accomplished. And in the end of the day, it took that speed from 17 milliseconds to 13. Just to give you a reference, that's about 5 times faster than a human blink. So it's incredible the amount of money that is at stake when you can accelerate information so that you can take advantage of arbitrage. Okay, here's the last strategy, and then we'll conclude with a few remarks. We'll open it up for questions. Event-driven investing. What does this mean? Well, let's say you have some opinion of Starbucks, doesn't matter if you like it or hate it, but you just believe that something is going to happen. So you can see here, we think Starbucks is going to buy its biggest rival in Japan, and if that happens, the shares of that competitor, meaning that Japanese company, they're going to jump when they announce the acquisition. Therefore, you buy shares in that competitor today. So practically speaking, what event-driven investing means is you are anticipating different outcomes. Maybe it is M&A, mergers and acquisitions. Maybe we should have put a red outline around that. Maybe it's bankruptcy. Maybe it's the outcome of clinical trials for new drugs, or maybe it's a legislative outcome. In all cases, someone believes that a stock's price is going to move, maybe up, maybe down, in about another month or so. So traders utilizing event-driven strategy, they're really only trading on outcomes that could pop in the next month. If you think this is something that might happen 2 years from now, you're not going to invest in it today because there's too much volatility in the stock between now and when that when that information might actually get revealed. Now, in general, think about this as a probability. You should go long in a stock if you think the market hasn't priced in the likelihood of this event. You should go short if you think the market has overestimated the likelihood of this event. And we'll use some examples shortly to help crystallize this. So, as I mentioned, this is really just a matter of probability. You look at something and you say, I think this is a 40% chance of happening. And if, for whatever reason, you think the market only views it as a 20% chance, you should take action. So what I wanted to share with you here is there's the easy part of this, which is I'm going to choose an outcome and I'm going to estimate the EPS impact. So what is EPS? Earnings per share. In the most fundamental definition of what moves share prices, it is earnings per share, for reasons that I would love to explain, but this would be a big tangent. So if someone is super curious, please ask it in Q&A, but it would throw us off here. So if the easy part is saying, yep, here's what's going to happen and here's the impact on the stock, the hard part is figuring out, well, how many people agree with my analysis? Or in general, how much is the market baking in this outcome in the current stock price? So this is a phrase that gets used all the time, baked in. Is something baked in? Have you baked this in? Is the market baking this in? And again, what it means is to what extent is the current value of a share reflective of this future unknown outcome? Okay, many of you know that Cadence was started in Beijing and the majority of our team is in Beijing. So let's have a fun thought exercise. Let's say that you believe Facebook is going to get unblocked starting October 1st, so in a couple of months. If that happens, Facebook is going to have access to 1.3 billion new users. And the more users Facebook gets, the higher revenue they get, which is more earnings, which is more EPS, earnings per share, which means their shares go up. Relatively simple logic, right? So how would we trade around that? So there's gonna be a lot of numbers here, so bear with me. First thing you need to do is ask yourself, well, is the information that I now believe to be true going to affect my view on the stock? So let's say Facebook today has 2.23 billion users. And let's say that the street estimate, I'm going to explain that in a second, the street estimate for the number of users by 2020 is 2.5 billion. What I'm saying here is this is the consensus of analysts who work in the finance industry who cover Facebook. Obviously, it references Wall Street, and it would, in the most literal sense, say, what is the consensus of people on Wall Street? But in today's global world, these analysts can be anywhere. And I'd love to tell you about kind of how these consensus estimates come together and how you can look up consensus estimates. So maybe that's a good question for Q&A. The point here is the street estimates this number. Now, if you think that this rumor is going to happen, you may think, you know what, they're going to get 400 million new users in China and maybe 200 million users outside of China. So the point is, your forecast for 2020 is much higher than the street. So you think that this means the stock is underpriced. So now you have to decide, well, how can I take advantage of this information? And what is the upside if I'm right? So bear with me for a little bit of math here. The market cap of Facebook is right now about $625 billion. It was about 800 billion not too long ago, but something happened. Now, if you divide that per user, that means there's roughly $280 of market cap per user. And in this example I've just mentioned, You think that the market cap is going to pop if all of these missing users get added. And how much will it pop? Well, we just said 400 million users at $280 per user. So your analysis says, you know what, I think this market share, or excuse me, this market cap could go up to 737 whenever this happens. Now, furthermore, let's say we buy it today, August 2nd or August 3rd if you're in Asia. Let's say this policy gets announced a month from now. You've held a stock for about a month, and in that time, all of a sudden it pops. That gives you a percentage return. But if you're talking to your investment committee or if you're modeling this, you don't really care about the investment return in absolute. You want to look at it on what's called an IRR basis. IRR stands for internal rate of return. And it's a really simple concept with a somewhat intimidating name. It just looks at the annualized impact of something. So if I make 10% growth in 1 month, the IRR for that is going to be 1.1 raised to the power of 12. Again, the simple way to think about it is if this outcome were to happen throughout the entire year, what would my return be? And in this case, it would be a 500% return for getting that type of upside in a month. So these types of event-driven strategies are really focused on what's a short-term opportunity that if I get it right, it pops. Now, it's important to say that there's really not a fund that is only focused on event-driven investing. This is really a tool in the tool belt of some of the best hedge funds that are out there. I'm not going to play this video for you, but this is the first episode of an amazing TV show called Billions. And the very, very first time you see one of the main characters in this show, he's, as you can see here, looking out on his trading floor, and someone comes up to him with a trading idea, and it is an event-driven trading strategy. Highly recommend the show, and if you want to get a taste of it, I think we have the link somewhere of this little segment. So these are the key trading strategies. We started very simply with long short, which is I like a company, I'm going to buy it, or I don't like a company, I'm going to short it. We went through algorithmic trading strategies, which is basically using IBM Watson or AI to give you some direction to make your trading decisions, or let the computer do the trading for you. We also talked about arbitrage, which is taking advantage of short-term profit opportunities. And we concluded with event-driven investing, which really is kind of in between some of these because you do need to have some fundamental outlook on a market or a company. And you also need to be able to take advantage of what you think is a mispriced asset in the market. So just to give some concluding thoughts, it's important to understand that these different strategies are very, very different from one another. In some cases, they are highly reliant on understanding the underlying companies. The trading strategies here would include being long short or event-driven strategies, and others are just black boxes. Doesn't matter if these companies are in Canada or in Europe, doesn't matter if they're small companies or big companies, it's all just numbers for the black box. That's what you tend to see in algorithmic trading and in the arbitrage strategy we mentioned. Another thing I want to point out is these are strategies and we're using equities as an example to execute these strategies. We're using Starbucks and Apple as a way to say, if you wanted to do this strategy, equities would be one way of doing it. But it's important to note that if you're really, really confident that a company is going to grow, you don't necessarily have to buy their stock to benefit from that. And again, that might be a good question to dive into a little bit later. And lastly, it's exciting to say that technology and lower trading costs are what's making all of this possible. No longer are you having to call a broker who then has to call someone on the trading floor and you end up paying $100 for a trade, right? This happens instantly and at much lower cost. So hopefully, over the last 35 minutes, you've learned what a hedge fund is. You've learned different ways that they can make money. You've learned about important terminology that might come up. And you've learned a thing or two about either entertainment that highlights the hedge fund industry, or how in my own personal journey as an entrepreneur and being in this space, my understanding evolved here as well. Now, I hope you're hungry for more information. What I would suggest, if you want to learn more, I tell my team this all the time. Sometimes they laugh at me, but read the Wall Street Journal or the Financial Times. Really, this is the lifeblood of the industry, and understanding what hedge funds are focused on can be gleaned if you're reading these publications. We're going to do another webinar on private equity later this month. So if you remember, private equity was one of those buy-side asset classes that we mentioned at the beginning. They also have investment strategies. They are very, very different from these, so I would encourage you to attend. And I published a blog post on this exact topic, which is the same structure in going strategy by strategy, but covers different elements of it. So I would also encourage you to read that. In general, at Cadence, we're going to be putting more and more effort into educating our linguists, educating our community. Maybe it'll be in the form of webinars like this, maybe it'll be in the form of downloadable content, but recognize that this is something we're putting out to the community to help you all level up your knowledge and gain a better understanding of how all of this works. So I would encourage you to start thinking about your questions because we have come to the end of the prepared remarks. We do everything on a hustler basis. So for example, a lot of the resources you saw here, both photographs and presentation templates, came from these resources. I want to thank my team for putting together the slides here. And obviously, at the end of the day, this is for your benefit. So we're really, really excited to have everyone here. So let me present this slide as just a means of guiding some of the Q&A that might happen. So again, there's a little Q&A button at the bottom of your screen. Feel free to type something in. I will be able to see it on my side, and we will take it from there. So looking forward to your questions. We're going to sit tight here to see what questions people might have. Okay, one question. Oh, wow, here come the questions. In what way, if any, would the arbitrage strategy be affected by an international trade war? Well, as an American who spent 5 years of his life in China, I don't know what you're talking about. Trade wars never break out. No, so it is true that this is something that is quite serious. So what would that look like? That's an excellent question. Think about it as all of a sudden tariffs come up. And if you want to ship a car from the US to China, China is going to impose a tariff on that. So an arbitrage opportunity might come up where you say, you know what, maybe I ship the cars to, I was going to say Japan, but that might also be problematic. Maybe I ship the cars to Vietnam, and then the cars go from Vietnam into China because there are no tariffs when goods go from China to Vietnam. So the arbitrage opportunity would be, okay, let me sell some cars to someone in China for a fixed price. I'm going to buy them from my factory, or essentially build them. And I'm going to lock in a transportation from one part of the world to another. And in theory, assuming no regulatory changes, I've locked in some profit. Now, that particular answer isn't really in the spirit of arbitrage, to be honest, because there's a lot of time necessary to move these goods. But in general, you can think of it that way as, okay, two countries who no longer are able to have free trade might give me an arbitrage opportunity if I can find a third country to route it through. Okay, next question. Can you talk about some of the asset classes outside of equity that hedge funds trade in? Oh man, this is fun. So hedge funds can do literally anything for the most part. My old boss worked at a hedge fund that bought and sold aircraft leases as a trading strategy. They felt that there was a market for buying something and a market for selling something, and they could profit from being in both of those. So other asset classes that this could include could be real estate, right? There's nothing to stop a hedge fund from buying a big building, sitting on it, and selling it a little bit later. Or they could buy debt in a company. Even these days, I hate to say it, but hedge funds could invest in cryptocurrency as an asset class to help them get the returns they need. We've seen quite a bit. I think we've even seen celebrity income as an asset class where a hedge fund will say, we're going to give you $1 million and you have to give us some percentage of your lifetime income. So it quickly goes into the realm of the absurd when you think of some of the asset classes that hedge funds can invest in. Okay, one question, what does quant stand for? Quantitative is the basis for what quant stands for. You can see here, if you're doing quant investing, it is quantitative investing. If you call somebody a quant, that means they're a quantitative trader. And actually one of Cadence's favorite companies, which I alluded to earlier, is called Quantopian. And they do algorithmic trading. The idea there is we are going to give the world an ecosystem to try out different algorithms, and we will pay if those algorithms do well. So quant always in this world refers to anything having to do with quantitative trading or analysis. Okay, there's one more question, so hopefully we can get a few more in the queue before we sign off here. So in what situation should we adopt the arbitrage strategy? In this one, this is highly risky because you need at least two things to come together. You need the transaction of buying it, the transaction of selling it, and you have to time it such that you can execute both at the same time and lock in your profit. So situations where a hedge fund might adopt this is if they really have identified perhaps a desperate buyer or a desperate seller. Because if they are just looking online on their Bloomberg terminal or on Yahoo Finance or Google Finance and they see, oh, well, something is priced here in this market and here in that market, that is public information that everyone can see. And in 2018, it's almost impossible to think of an arbitrage opportunity that is spotted from the public markets. So the situation that you're really looking for is any privileged information. Doesn't have to be illegally obtained by any means. It could just be, you heard that a shipwreck occurred and there's going to be an arbitrage opportunity where there's all of a sudden going to be a spike in prices because that was carrying coal or whatever. So what you might want to do is say, I'm going to buy coal futures in one market and sell them in another and try to lock in, or excuse me, sell spots on coal futures in order to lock that in. So that'd be a good example of using arbitrage based on kind of privileged information. Okay, so our plan, if there were kind of no questions, but we still had people on the webinar, was actually to go over some of the terminology, either that was in this presentation highlighted in red, or we have some other ones that come up quite often that we think are fun to talk about. So let me pull up that blog article for us, and you'll see this kind of supplementary terminology that we find useful. So here's the article I was talking about. I hope that people would find it useful afterwards. So let's zoom in on some of these amusing but quite frequently used phrases. The first one is beige book. I don't know if anyone here wants to try to describe what the beige book is. Feel free to mention in Q&A or even use the raise hand feature if you want to try to define these. But in our world, beige book is what the Federal Reserve, which is the central bank of the US, puts out to explain their prior decisions and also to give some future indications of what they view the market as. So you may very well be in a meeting or on a call or listening to some audio where they say, well, we were following what the beige book was implying. And again, that can be understood as what is the US Federal Reserve implying. Next word, I love this one, BIPS, B-I-P-S. When you say it out loud, you say BIPS. When you spell it, it often is BPS. Very simple to understand. It means basis points. 1% is equal to 100 basis points. So whereas we might say, well, the Dow went up 1.2% today, in theory, you could also say, oh, the Dow gained 120 bips. In reality, you use bips more to talk about interest rates or that type of thing as opposed to day-over-day gains. But that phrase, bips, is very memorable, and we think everyone here should know it. EMH. This is something that I bet if you put it into Google, you'll find so many different things that this could potentially refer to. In the finance world, it stands for efficient market hypothesis. So the whole point of investing is you have a belief that something is underpriced or mispriced, I should say. Now, some academics, particularly out of the University of Chicago, really hold true that there is an efficient market out there and that as soon as information becomes public, it gets transmitted to everyone in the world. So the value of that information erodes as soon as it comes out. Some people believe that very literally, and that is called believing in the strong version of the EMH. Some people don't think that that's true, and they would be described as subscribing to the weak version of the EMH. So in general, that's just a common thing that you might hear. Evergreen. This is particularly special because it is a finance word, and it also happens to be the town that I grew up in Colorado. In the finance world, what it refers to is a fund that is able to continuously return capital to itself and invest further. And you may think, well, yeah, duh, isn't that how all funds work? And actually the answer is no. If you remember at the beginning of this webinar, we said there are people that invest in the buy side. So if you invest in the buy side, it comes with a guarantee or a maximum holding period before you get your money back. Whereas an evergreen fund effectively says, we never give money back to our investors. We put all of those gains back into the fund to just grow, grow, grow. Float, we talked about, but once again, that is the amount of shares that are available to be purchased. A lot of people think that, oh, well, Facebook shares, if I were to somehow get all the money in the world to buy every single share, I could. The reality is no, they only will float a certain number of shares. Finally, or not finally, we're almost there, muddy waters. This is a evocative phrase that refers actually to a participant in the finance world. I'm actually going to be publishing a blog post very soon, if not already, about who Muddy Waters is. For purposes of this webinar, just know it is someone who is insanely focused on uncovering fraud, meaning they go out and they investigate if a company is cooking the books, which is another great phrase we should maybe put on here. So the point is, if a hedge fund is long in a company that Muddy Waters goes after, the hedge fund is panicking because they're saying, gosh, we own this company. We thought it was a solid company, but now we heard Muddy Waters is going after it. That means there might be fraud at the company. Okay, I do see a question was asked, so I'll get to that in 1 second. Short squeeze, I had mentioned that at first, earlier when we were talking about people will go out into the world and they will say, you know what, I don't like you. I want to make money if you fail. That is a mean-spirited but arguably valid way of making money. Now, what may happen though is someone might say, I am short Tesla. And at some point, remember, you had to borrow shares from somebody in order to enter into this trading position. So some people might want all of their shares back. And if that happens all at the same time, it becomes what's known as a short squeeze, because the people who had a short position all of a sudden are having to buy shares back from the open market in order to give those back. So think of it in more simpler terms as kind of a run on the bank, meaning everyone is trying to unwind out of some financial commitment they made all at the same time. Last one is waterfall. So we didn't really talk about non-equities asset classes here, but what hedge funds will often do to make money is they will say, I think this company is going to liquidate. Maybe it's a good thing because they're getting sold. Maybe it's a bad thing because they're going bankrupt. But either way, they're going to go through some liquidation. Now, the rules that govern what happens when a company liquidates itself are typically set by the different shares or different types of debt that the company has issued. So the combined prioritization of those different asset classes is known as the waterfall. So it might look something like, well, if Facebook buys Snapchat, the preferred shares get paid out first and then the common shares. Or maybe if Facebook buys Snapchat, the debt that the company owns gets paid back first and then the preferred stock and then the common stock. That concept of who gets paid and in what order is the waterfall. Okay, there was a question, what is the appeal of an evergreen fund to investors versus a traditional hedge fund? That is a fantastic question. And it's actually the case that if you're an investor, you typically don't want to invest in an evergreen fund. So a evergreen fund is typically set up by the hedge fund themselves. There's a very famous hedge fund manager in the US named Stephen Cohen who would take money from outside investors. He got into a little bit of trouble with the regulatory body in the United States, and they said, you are no longer allowed to take outside money. So as a result, he just manages his own money. He still has plenty of it. And that can be thought of as an evergreen fund. So from the investor's perspective, it's not necessarily that they're looking for an evergreen fund. It's that that's more of an outcome of certain circumstances. There are exceptions to this, of course, but for the most part, that's how that fund is marketed or not marketed to investors. Okay, so we have a couple more minutes. Happy to answer more questions, but I do imagine this was a lot of content for people to go through. Again, we don't want anybody to be intimidated by this. It's a subject that we feel very passionately about, that we love sharing information about, but it is complicated for a reason. And so we hope that this was a plain English way of introducing some of the concepts that are out there. Now, that being said, feedback means a lot to us. So certainly write back to us. Let us know what you liked about this, what you didn't, because we do want to adapt these webinars in the future to make sure that it benefits all of you out there. So I will give one more window for questions, but if not, I'm more than happy to give everybody 5 minutes back in their day. Okay, folks. Well, once again, if you enjoyed this, please go to cadencetranslate.com/learn, where we have more information. Expect to see a lot more of these, and anything else, you know where to find us. So thank you very much. May you all go forward and make a lot of money using these investment strategies. All right, thank you, everyone. Bye-bye.